Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets behind corporate filings. And guess what, today we are diving into ScanTech AI Systems Incorporated's latest report. And let me tell you, it is quite a story of a company trying to navigate some serious financial and operational hurdles. This isn't just another quarterly update. This is a company facing some big challenges and trying to reorganize its entire financial structure. Before we jump in, if you love getting these straightforward breakdowns of complex financial documents, make sure you hit that subscribe button and the notification bell. We also have a fantastic community over on our Discord server, linked in the description below, where we discuss these filings and so much more. Come join the conversation. So ScanTech AI Systems Incorporated, as you can see from this report, is giving us a look at their picture as of the 30th of June 2025. But the first thing that jumps out is that this isn't just a regular report, it is an amendment meaning they are correcting or adding to a previous filing. The explanatory note tells us they are restating their financial statements for quarters ending the 30th of June 2025 to fix some errors. It seems like there were issues with revenue cost of goods sold, general and administrative expenses, even research and development. Basically a big cleanup operation. Let's start by looking at their balance sheet to get a feel for where they stand financially. On the 30th of June 2025, ScanTech had about $4.6 million in total assets. That might sound like a lot, but when you look at their liabilities, it's a different story. Their total liabilities were a staggering $45 million. Yes, you heard that right. Their liabilities are almost 10 times their assets. This is a massive red flag, folks. They have a working capital deficit of over $22 million, meaning they owe more in the short term than they have available. Something else that caught my eye here is this line item security pledged to creditors' common stock. As of the 30th of June 2025, they had over $2 million worth of their own common stock pledged to creditors. This is essentially saying they use their own shares as collateral to secure loans, which is a pretty desperate measure. Now let's switch gears and look at how the company performed financially in terms of income and expenses. For the 3 months ending the 30th of June 2025, they reported revenue of about $884,000. That sounds okay, but their cost of goods sold was even higher at $757,000. And then you see their operating expenses, which include general and administrative, as well as research and development expenses. They racked up over $4 million in operating expenses for just that 3-month period. The result: a loss from operations of nearly $3.9 million. If we look at the 6-month period ending the 30th of June 2025, the picture gets even more concerning. Their revenue was only about $1.2 million, but their total operating expenses ballooned to almost $20 million. That is a huge jump from the same period the year before, and it leads to a massive loss from operations of nearly $19.5 million for just 6 months. And it does not stop there. When we look at other expenses, things like changes in fair value of derivative and warrant liabilities and interest expenses, things get really bad. For the 6-month period, other expenses were over $5 million. This is in addition to their operating losses. The bottom line here is a significant net loss. For the 3 months ending the 30th of June 2025, they reported a net loss of almost $7 million. And for the 6-month period, that loss shot up to nearly $25 million. That is a lot of red ink. Digging into the shareholders' deficit section, we see a complicated structure of different unit classes. For example, the series of preferred non-voting units had a significant amount attributed to them. The report mentions these units are subject to possible redemption and carry an 8% per annum rate of return. This sounds like they owe these unit holders a substantial amount of money, and that obligation is a big part of their financial picture. Looking at their common stock situation, it is a bit of a roller coaster. As of the 30th of June 2025, they had about 48.2 million shares issued and outstanding. This is a huge jump from just 14.1 million shares at the end of 2024. This massive increase in shares is a result of all the debt conversions and settlement agreements we've seen mentioned throughout the report. While more shares can sometimes mean growth, it also means significant dilution for existing shareholders. The report details a lot of debt being converted into common stock. This is a common strategy when a company is struggling to pay its debts. Essentially, they are trading what they owe for equity. For example, over 10 million shares of common stock were issued to settle debts representing over $21 million in additional paid-in capital. However, it also means the company had to issue a lot of new stock, diluting everyone else's ownership. The company explicitly mentions a troubled debt restructuring in Note 3. This means they were in financial difficulty and had to negotiate with creditors under unfavorable terms. They converted over $104 million of debt into shares valued at only $20.5 million. This resulted in a massive gain on debt extinguishment of $83.7 million, which sounds good, but it is really a sign of how much trouble they were in. Even the wording here is telling. This is concerning. ScanTech failed to remit us federal taxes for an extended period from 2017 to 2023. They owe a whopping $5.9 million in accrued federal tax liability penalties and interest as of June 2025. They are making payments, but the sheer amount owed and the penalties highlight a serious operational and compliance issue. There is even a disclaimer about potential criminal charges and the uncertainty of IRS settlements. That is not the kind of language you want to see from a healthy company. The Series A units are another financial puzzle. They are described as redeemable at any time if the company hasn't achieved a qualified IPO or change of control. This puts a lot of power in the hands of these unit holders, potentially forcing a redemption that the company might not be able to afford. They are classified as mezzanine equity, which is a bit of a middle ground between debt and equity, but it underscores the complexity and potential risk. Now, here is a major risk factor. ScanTech is currently not in compliance with several NASDAQ listing requirements. They've received notices about the minimum market value of their listed securities, the minimum bid price, and the market value of publicly held shares. They have specific deadlines to fix these issues or face delisting. This is a critical situation that could severely impact their stock's liquidity and value. It signals the market's lack of confidence. This phrase is incredibly telling. ScanTech openly admits they have no committed external source of funds for future operations. They are reliant on the hope of raising money through equity sales, debt, or other deals that might not happen. Coupled with their substantial losses and liabilities, this creates a very precarious going concern situation. So what is the story here? ScanTech AI Systems Incorporated is in some serious financial trouble. They have immense liabilities far outweighing their assets. They've had to convert a massive amount of debt into equity, which is diluting shareholders and is a sign of distress. They are also facing critical non-compliance issues with the NASDAQ exchange, which could lead to delisting. Add to that the significant unpaid tax liabilities and the uncertainty around future funding, and you have a company facing an uphill battle. While they are working on a novel security scanning technology, the financial and operational hurdles are immense. The restatement of their financials suggests a desire for transparency, but the underlying numbers paint a picture of a company struggling to stay afloat. For investors, this situation is extremely high risk. They need to find a way to dramatically increase revenue, secure sustainable funding, and prove they can meet their financial and regulatory obligations. Without significant positive developments in the very near future, their future looks uncertain. What is your take on ScanTech's situation? Do you think they can turn things around, or is this a company we should watch from a distance? Let me know your thoughts in the comments below. If you found this deep dive valuable, please hit that like button and subscribe for more of these corporate breakdowns. And don't forget to join our Discord community, linked in the description for more exclusive content and discussion. Thanks for watching, and I'll see you in the next video.